because that was the right decision for him. So you start with goals, and then you bring in, if we have tools that can help accomplish the goals, that's when we talk about those.
Hi, this is Dave Steinberg. Welcome to the Mortgages Made Easy podcast. We're here with my friend, John Thompson. John is a 20-year friend. Can you believe that, John? We've known each other.
It's hard to believe, Dave. And we both never look better. So thank you.
And he's the guy with the tan.
John is, you know where I live. That's why I have a tan. But yeah,
John is a California-based lender with SMPL Mortgage, and you're the president of the company.
I'm the founder, but it's at the end of the day, it's my little team, my group, and a handful of us. Yeah.
And he is one of the smartest guys I know in the mortgage industry. So when I had the opportunity to bring him on and share some ideas, I jumped at the opportunity. John, tell me about reverse mortgages. How are you using them? When is a reverse mortgage a good tool for a client?
Well, thank you, Dave, and thank you again for kind of having me here. And I appreciate the compliment of being the smartest person. I certainly don't think I am, but I do try and pay attention. And because of our work together, I think we're both learning from each other, which I think is really valuable in all businesses. But you know, and it applies in a kind of odd little way to reverse mortgages and teaching clients about it, because at the end of the day, you know, I'm learning from my clients about how they might use a reverse mortgage and how it helps solve some of their problems. I learn from other mortgage professionals by going to events and chatting with people. I was on a webinar just before this with a coach who happens to specialize in the reverse mortgage space. I picked up some great ideas from her. And then, of course, from our partners, right? How they, you know, financial planners and other financial professionals that might think about, you know, bringing a reverse mortgage in their space. So, at the end of the day, I've been focused on in part of our practice on reverse mortgages now for going on, you know, it's almost 10 years now. And my very first reverse mortgage, I was forced to do it by an insurance guy who said, look, my mom needs a reverse mortgage. I don't know a lot about them. And I'm like, I don't either. And he goes, yeah, but you're smart. You'll figure it out. Right. And so I did figure it out and we got it done. And it was just life altering for her, life changing.
In what way?
Well, she was able, so she was in her mid 60s. She was still teaching at a school. She was a teacher. So she's still teaching at a school to make ends meet because she had a payment on her condo. And she had a car payment and she had a few little bills. And it was just, she could get by, but she wasn't getting ahead, right? And the reason the son wanted to be involved was because mom was kind of their backup babysitter and she couldn't be there enough, right? She's like, she's working. I need her to take care of my kids and be around and enjoy them and while she still can. So it's a great story. So to cut it short, I mean, we paid off her mortgage, which freed up cash flow. We paid off the car loan and got her a little bit of extra money and a small line of credit, which gave her protection over time. So she literally quit her job the week after, we closed the reverse and is now spending a lot more time with her kids and her grandkids.
And leading a better life, I imagine.
Sure. So I mean, this is all about, in her case, it was about lifestyle, but not just her lifestyle. It was the people around her, her family, even the community. She wanted to get more involved in a church and just didn't feel like she could contribute there because of some things like that. So it was a heartwarming story, and almost all of them are that way. The reverse mortgage, we could talk for hours about how it works and the features and benefits, but that's not important, I don't think. What's important is sort of how it affects people's lives and how it can make a big difference in people. And when I talk to financial planners, and like you and I, we tend to think about numbers, right? I'm a very linear thinker. I want to analyze the numbers and make it make sense. And oftentimes it does make financial sense. But financial planners really think that way, right? And so they tend to not always focus on the human aspect of what I just said, right? Grandma got to quit her job, free up time, free up cash flow to be able to spend more time with her family, which gave her a better quality of life. and better quality of life for her kids, right? And so when you think of how we might bring equity, home equity, into a conversation around finances and longevity and sustainability and lifestyle, that's where a reverse mortgage kind of can fit. And it's not for everyone, right? But it should not be overlooked. And I think many people overlook the idea of, maybe reverse. If someone wants to sell and downsize, great. But sometimes that's not always the right choice. So anyway, that's a long-winded way of saying it can be very creative and interesting for people.
And what I love about your story, and what I consider the first step in any reverse mortgage, is getting the family involved.
Yeah.
And then, so my feeling is, to the extent that we can get the son involved, the family involved. I'm currently working with a physician who is, who's trying to keep his mom in her house. And really, mom is like 90 some odd years old. The only way that he can do that is to get additional money. Now, mom has a $1 million house that's all paid up. We figured out that she can get $7,000 plus a month on a reverse mortgage. And that goes a long way towards paying the aides that are probably running $2,000 plus a month. So instead of him paying $8,000 a month out of his pocket, which is a painful number, if he can get it down to paying a few $100 or maybe $1,000 a month to keep her in the house, it's just brilliant. And that's the key in my mind to the success, is to make sure that all the stakeholders are represented in the conversation. The parent, the children, the financial planner, the CPA, get them all involved.
And it goes even further beyond that. So in that story you're sharing with us, at the same time, for them to use that asset to create the cash flow for mom to take care of mom also means that the successful son also doesn't have to start contributing that money. At the end of the day, that affects his finances as well, right? And so if suddenly he's contributing $5,000 or $6,000 or $7,000, or other family members in general are helping support mom or dad or whoever they are, that affects their finances and their ability to retire and pay for education, and which is sort of why I think these are generational decisions, right? It really doesn't affect just the senior or their parent. It can affect their grandchildren, right? It's a whole, which is what makes it so fun to work on them, right? But you're right. Everyone has to be at the table to the degree you can. Sometimes people don't want to get involved. But the more you can, the better, ultimately. You're absolutely right.
And, there's so many fears that are related to reverse mortgage, because everyone has heard reverse mortgage horror stories. Have you encountered that, and how do you address it?
I've encountered clients telling me about, things they've heard and so forth. I haven't really had a negative situation ever occur with one of our clients in the last 10 years that we've closed. We've had some issues with servicing and things like that. And, like you jump in and you help your clients. It doesn't matter if they closed 2 weeks ago or 2 years ago or 20 years ago. You help them no matter what and what they have to do. So the things we tend to hear are, my neighbor had a reverse mortgage and it really blew up on them. It went really badly. I go, gosh, I'm really sorry to hear that. Tell me more about it. And so then they go, well, it was just a story I heard, and maybe they heard a story that someone lost their house. The reality is that most consumers have heard the stories. They don't really know the genesis of the story. They don't really know what happened. And what we found when we have typically tracked backwards, people tend to lose their homes if they have a reverse mortgage because they miss one of the other requirements: paying property taxes, maintaining insurance, even maintaining the home in a decent condition, or forgetting to return back the certificate that says they live in the home every year, which is a requirement. So they just forget to do it, or they miss it, or they have a caregiver and the caregiver doesn't know that it's important. So it tends to be one of those other kinds of things. But what I do tell people is there's been a lot of regulation changes in the mortgage in the last several years, most notably in 2014 and 15, and again in 2017. And those changes have made it much safer for older homeowners. And there's protections built into it now. And then you can go into what the protections are. But yeah, we do here. And by the way, I'll tell you, Dave, and you probably do the same thing. Every time I'm talking to the client about a reverse mortgage or a partner about it, the first thing is, what do you know? Like, what have you heard? Like, I want to hear all that stuff up front, because they have an opinion. I mean, it's not the first time they suddenly heard about a reverse mortgage, right? So
Right.
I want them to tell me what they know and what they've heard so we can address it.
Yeah. And and just to cut to the quick, the truth is that they're not going to lose their house.
Yeah.
And the truth is that their heirs, after they pass, will get the residual value of the home. So if
Absolutely.
there's a house that's worth $500,000 today and they put a reverse mortgage on it and the parent passes, let's say after 5 years, there's probably going to be a very significant amount of equity left in the house, and that goes to the heirs. The bank doesn't get it. The bank doesn't steal the house, which is the fear.
Absolutely. And like I say, from that perspective, it's just like any other mortgage. If you owe the same amount of money on a normal forward conventional mortgage, it's the same thing, right? You pay off the debt and you get the equity. No difference.
Yeah. What about what would you tell a financial advisor whose client calls up and says, hey, Bill, I'm getting older, don't have the income to maintain my house anymore, but I really want to stay here. What do you tell the financial advisor?
I would ask, what options are they already looking at, right? So they've probably already gone through sort of a needs and goals and discovery process with the client. And have you considered downsizing? Have you considered selling and renting? Have you considered building an accessory dwelling unit and moving into the dwelling unit and renting out your house? I mean, there's lots of different things you could think about. And so, and a good advisor, a good financial planner is hopefully have gone through those things. If they're calling me, they're probably at the point where they're starting to explore the idea of bringing home equity into the plan. And then we talk about it from there. But I do want to go back and just explore everything. I mean, I have a great example, a client who just very recently was going to sell his home. His wife has dementia and he's caring for her. He really wants her to stay in the home. And, it's a 3-story home. So there's stairs and they can't get up and down. It's really difficult. So he was going to sell and downsize to go to another home. And I I just sense he did not want to leave the house. I could tell he was passionate about his home. And just was having a hard time leaving it. So I kept going back and back and back and saying, have you thought about remodeling? Have you thought about doing other things to enable you to stay? Long story short, he's actually going to stay. He decided not to sell. I talked myself out of mortgage and so he's going to stay in the home and that's fine because that was the right decision for him. So you start with goals and then you bring in, if we have tools that can help accomplish your goals, that's when we talk about those.
Yeah, exactly. Who do you think benefits the most? It's interesting to me that you started with a client in their 60s. Of course, most often in my practice, I'm talking to people who are in their 70s or 80s. I did get an inquiry for somebody who was in their young 60s and it just didn't work. But, let's talk about how reverse mortgages work. So let's say you have a home that's worth $1 million, just to keep the numbers easy. And what the lender's going to do is they're going to go to the life expectancy table. And so if a senior is 80, the life expectancy may be 10 years. If they're 70, it may be 20 years. And that life expectancy then determines how much money the senior can get every month, right? And what they do is they say, okay, if this person who's 70 years old gets $2,500 a month for the next 20 years, they'll do the math and and then there's interest on it, right? Because like any mortgage, there's interest on it. So they'll take the mortgage, they'll take the interest, they'll wrap it up in a bowl, and they'll make sure that there's money left in on the table to pay for all of that. And that's how reverse mortgages are underwritten, which again goes back to the concern that many consumers have. What will happen after I pass?
Yeah. Yeah. And so, yeah, so that calculation, is the technical term is, the principal limit. And so, and you based on that on that $1 million home that you just sort of threw out there, if you're younger, maybe you can borrow 34%, again, to kind of move it to the other way, maybe a financial planner might think, because people tend to ask, well, what's my loan to value, which is a term that we're used to on the forward side or conventional side of the mortgage business. But it doesn't apply necessarily in the reverse mortgage because there's 3 or 4 factors that control how much you can borrow. But the younger you are, the less you can borrow is the bottom line. So maybe it's 30 or 34%. And as you get older, maybe it goes up to 40 or 42. And if you get really lucky and you're 90 and you're still chugging away, you're doing great, then fine. Maybe it's, 50 or 55%. It's still not, because most people believe, this is one of the really common misconceptions, even amongst financial professionals, that, well, I have a home, it's worth $1 million. I don't owe anything on it. I should be able to get my $1 million. And that's their belief that they can get all the money out of it. And they might ultimately get all the money out of it, but not initially. It'll be that drawdown and then the deferred interest over time, unless they make a payment. But yeah, and so that's how someone qualifies for it. They need to have, decent credit. They need to have a little bit of income and some things like that. There's some other requirements. But generally speaking, you're right. You can borrow a certain percentage and you go from there.
John, this has been so valuable. Thank you so much for taking the time, and I'll have you back soon. Thank you so much.
No, absolutely. I appreciate it.